The market was fairly mixed yesterday, although we are starting to see the continuation of the downtrend from just a few weeks ago. Although having said that, over the last 5 days, the market has been very green, and one of the largest drivers in fact has been the semiconductor space. Nvidia up 17%, Broadcom up 15%, AMD up 22%. But unfortunately, we are looking at a very red pre-market. We see Nvidia down nearly 6%, AMD down around 7%, and we're going to just touch upon one of the reasons why this may be the case. But the real focus of today's episode is going to be on ASML, which did report their earnings just before the market opened, and they are now down more than 4%. So we're going to discuss why the company is down, why we believe it to be an incredible buying opportunity, as well as the fundamentals, the underlying metrics. Now look, over the last year, they have suffered, down 28%. Year to date, however, they are down only marginally too. Will be slightly bigger when the market opens, but over the last 10 years, very important metric, they have outperformed the S&P, up 538. We're going to show you quite a substantial outperformance as well. And at the moment, they are trading near their 52-week low, quite a significant away from their all-time highs at $1,110. In fact, nearly 50% lower. And we can see both Seeking Alpha and Wall Street do call this company a buy. They offer a yield near 0.8% and a forward valuation around the 25 to 26 mark. But first, let's touch upon their earnings and understand why the company is down in the pre-market. And we can see straight away they missed their order expectations, and surprise, surprise, tariff uncertainty has been one of those reasons that has in fact been cited. So their net bookings is around 3.94 billion euros, and we can see analysts want to see a lot higher at 4.89. So one of the drivers of the drop we are seeing. And the CEO does touch upon tariffs, talking about a new uncertainty and therefore perhaps starting to affect some of their demands, which in turn, as we just saw, has affected their net bookings. Now, when we take a bit of a deeper dive to understand this company and the issues it is maybe facing, we can see their actual numbers for the quarter, 7.74 billion on the top line, slightly below analyst expectations of 7.8, and we also get a slightly higher net profit, 2.36 than forecast of 2.3 billion. Now, one of their largest indicators for their demand is in fact their net bookings, which as we said did come under analyst expectations, 3.94 billion, and that is for the first 3 months of 2025. We can see market expectation was 4.89 billion. Now, even though the CEO did talk about how the market overall is very strong, and again we're going to touch upon the expectations for 2030 and beyond, there should be no surprises from the market, from investors, that all of this tariff talks, all of these geopolitical tensions are creating uncertainty with some of their customers, and in fact we're going to show you quite a large portion of them are China, are Taiwan, and the implications for this, whilst they have stuck to their full year revenue guidance, means that they could perhaps go towards the lower end if we see the continuation of these issues. We can also just touch upon the tariff uncertainty, but as we said, they have stuck to what they do believe their top line will be for the year, 30 to 35 billion, but something that we probably will start to hear from a lot of CEOs. They are watching very closely what is happening with the tariffs, and we can see the CEO does believe this dynamic needs to be looked at very carefully, but they haven't changed their full year target. And we get an analyst here basically saying that the ASML will have a very large, in fact widespread issues if tariffs do come into play at these levels for quite a significant amount of time if we don't get any deals between countries, but that at just this point in time it is very early to really give any full analysis. And we can also see here that the global market as a whole has been very, very tough. But we did see last week the US administration, they did say smartphones, computers, as well as semiconductors are temporarily exempt. However, this is something that does change on a day-to-day basis. Donald Trump can come out with a tweet, he can release information, and we can see the market go one way or another. Things are changing very rapidly, but ultimately the large reason for the drop we have seen are the net bookings for ASML. As we can see, not only a drop from the previous quarter, but also in fact lower than analyst expectations. And one thing to understand about this company, it is in a cyclical industry, and therefore as we can just see from the net bookings on a quarter by quarter basis, it does vary very significantly. Now we have two things that we want to touch upon before we get into our analysis, which does affect ASML. They are in the semiconductor space, but we have TSMC, Taiwan Semiconductors, where we have news, although currently at the moment it is a rumor that they have started to increase their prices, in fact by 30%, and this is due to the tariff war. Whether or not we'll see any effect on their customers moving away from their products or in fact ordering less, again something to bear in mind. But maybe the largest news, which as we saw at the beginning of the episode, the pre-market, and we will cover this in a separate episode, is that Nvidia faces a 5.5 billion hit, and this is due to the fact that Donald Trump has placed some new restrictions on their exports over China. They essentially don't want what they believe in their eyes is China building a supercomputer, and this has ultimately affected the price, affected investor confidence, and that is a very significant amount if you just look at 5.5 billion in comparison to their latest quarter. Whilst they reported around 39 billion, we are talking more than 10% from just their latest quarterly earnings. Now we want to bring you back to ASML, which as we said is down more than 4% in the pre-market, and why we love this company at the moment is when we just purely look at a valuation, although we are going to do a deeper dive, this is just the starting point. At a valuation of 25.3, it is not only significantly below 33.9, their 5-year average, but in fact the lowest it has been valued at over the last 5 years. This is what we would call a severe undervaluation signal, and we can also note you are getting a high yield 0.93 than what they have offered over the last 5 at 0.84. That is also typically considered another undervaluation signal. And if we were to take a look at this model, which effectively tells us the expected price through the blue tunnel, this is the 5-year average P ratio, that the company right now sits below even the bottom point, disparity noted. That is again another severe undervaluation signal. Now we do want to point out, in terms of the gradings, they do get an F. The main reason for this is given the sector median sits a lot lower at 19, you are right now paying a 34% premium, but this is something to consider. Is ASML worth a premium to the sector? We believe the answer is yes, and we are going to talk you through why that is the case. The other thing, as we've just highlighted, they are currently valued nearly 37% lower than what they have done on a historical basis. And they do expect for the full year of 2025 to have some very strong growth to the earnings per share with a 100% historical track record. And if we do take a look at December 2026, they're trading based on these numbers at a valuation of 21.4. Now let's just take a quick look at some very important slides in their latest investor presentation. First thing to take away is they still anticipate their full year revenue to sit between 30 to 35 billion, but if we do get a lot more uncertainty, a lot more geopolitical tensions with these tariffs increasing in their rates, then the CEO says they anticipate this to be towards the lower end. But as we saw right now, they did report their sales 7.7 billion, roughly around analyst expectations, with a slight beat on the bottom line. And some of the key points that the CEO did talk about is that they anticipate this whole space to be larger than 1 trillion in revenue by 2030, something that we've also heard from Jensen Huang, CEO of Nvidia, as well as Lisa Su from AMD, and that they also anticipate an increased number of critical lithography exposures from essentially their customers, which is always a good sign. They do have an incredible wide moat, as we have covered in previous episodes, and they also anticipate revenue in 2030 to be around 44 to 60 billion, and not just that is something that we're very impressed with, but also an increase to their margins, 56 to 60%. Now we'll cover what they are currently. Now remember, on this channel, for a company to be high quality, it needs to meet 2 criteria: an increase to revenue, which the majority of companies do, but also an improvement on their efficiencies, their margins, again something we have noted on a consistent basis with ASML. And maybe the one that does go under the radar, they continue to return excess cash to shareholder pockets, not just through their dividends, but they've done a lot of share buybacks, something we've just seen in the last few months. We're going to touch upon this as well. And as we can see, if you want to see their quarterly one results, 7.7 billion on the top line, but their gross margin 54%, very strong. It was actually quite a way lower in just the previous quarter. And remember, this is a very cyclical business. Net sales in quarter 4, just the previous one, over 7 billion. In the latest quarter that we have just gone through, 5.7, and still they do have quite a lot of exposure to Taiwan and China. Last quarter it sat at 37%. We now see it more in fact at 43%, so definitely a consideration to have with the company, and that is why when we get to our own discounted cash flow model, we always apply a margin of safety. And this effectively showing us the decrease that we see in the net system bookings, 7.1 billion previous quarter, now sitting at just below 4, not only a decrease, from previous quarter, but also a decrease from analyst expectations. Again, bear in mind, cyclical industry. And one thing we always love to look at when we analyze companies is their capital allocation. Very important to understand what they're doing with any cash. And one thing we do really want to highlight, we'll talk about the dividend in a little bit, but just in the latest quarter, they purchased around 4 million shares for around 2.7 billion euros. What does this highlight? Well, in our opinion, this tells us management believe the share price right now has been very suppressed. They believe it is a great opportunity to buy, and really, if management believe this, they are a lot closer to the detail, then this should give us some faith that perhaps it is a good opportunity and something to take a closer look at. Now, for the next quarter, in terms of revenue, they expect 7.2 to 7.7. It looks like then it will be lower than what they just released in quarter one. Also, a decrease to their margin, 50 to 53%, when we saw it higher in just the previous quarter. And they also anticipate gross margin around the 51 to 53 for the full year, with revenue in line with previous guidance. And the final thing from the investor presentation that we did want to highlight is that whilst their gross sales very inconsistent, as we said, cyclical industry, their gross margin has improved to 54%, previous quarter 51.7, and you can only really have a increasing gross margin if you have a typical wide mode company, because any company cannot just come and start increasing their margins. Their customers would likely move away to cheaper alternatives, but we can see ASML, they can continue to increase their revenue, increase their margins, and they still have the customers. Although we should point out net bookings is below the previous quarter and the forecasted, but again, it is a cyclical industry. We also just want to touch upon institutional ownership, which sits at 26%. We see around 10.7 billion worth of sales over the last year, only a marginal amount more buying at 11.51 billion. So institutions, you could argue, neither bullish or bearish on a trailing 12-month basis, but if we just look at the most recent quarter, Q1, we see a lot more buying than selling, 1 billion versus 6 million worth of sales. So at least in the most recent quarter, institutions clearly a lot more bullish than they are bearish. And the other thing we will look at, while super investors portfolios do start to come in over the next few weeks, we can see the most recent one for quarter one. We have Hillman Value Fund, who reduced their shares by around 39%, although we can see it wasn't the largest percentage in its portfolio, and we've already covered this in a previous episode, but just in quarter 4 2024, David Tepper, quite a famous billionaire, he added a significant amount to his portfolio, 82,500 shares, but again, it isn't the largest position in his portfolio. But when we do deeper dives into each of these super investors, they hold a lot of positions at some fairly low percentages. Again, something just to flag. We'll also show you the underlying metrics of the company. Firstly, dividend safety score 82, very safe. We've covered these two severe undervaluation signals, and just last year they increased the dividend 4.8%, pretty much in line with inflation. Not something we do like to see for this company, as historically it has been very fast double digit. And we'll also just flag for those that want to know, it was reaffirmed just a few months ago, dividend is very safe, meaning a cut is highly unlikely for ASML. Now, for those that do believe we are effectively going to be heading into a recession soon, key metrics from the previous recession, 07-09, they actually cut the dividend, didn't increase, didn't maintain it. They had below average growth, negative 56%. S&P itself was negative 12, but in fact, they pretty much had a bang on S&P return at negative 55%. And remember, we did say pretty disappointed in last year's increase. We are expecting one then in the next few months, given, as we said, over the last 5 and the last 10 years, they've increased it at a very rapid rate. In fact, 25% year on year on average over the last 10, and they've been increasing the dividend on a consecutive basis for the last 15 years. As always, we will ignore the earnings data as it is susceptible to manipulation by management through accounting. We focus on free cash flow payout below 50% for the semi space. Reason for this gives us faith they can continue to offer double-digit increases to the dividend, and we noticed 28% in 2024, expected to be lower over the next year at 21%, so we'd be very surprised if we don't get a very juicy double-digit dividend increase. And as we've highlighted before, it is a cyclical company. Whilst for free cash flow, we would like an increase consistently over the longer term, it is fairly inconsistent, although a large increase from 10 years ago, $3.85 to $23, but we need to make you aware over the next 12 months, it is anticipated to drop to $15.90. Now, in terms of sales growth, a lot of inconsistency, but at least at a bare minimum, it is around the 3 to 7% level. 3% is pretty much just keeping up in line with inflation, which is what we saw in the most recent annual accounts. And if we look at it from a 10-year numerical period, we can see very, very rapid increase. 6 billion 10 years ago, now sitting at 28. We also talked about it earlier, returning excess cash to investor pockets through share buybacks. They've done exactly that, buying back nearly 10% over the last 10 years. And as we saw, they have been doing this quite aggressively in the most recent quarter. Management clearly believe the share price is undervalued. In terms of ROIC, 10% or more, or in fact 12% for the semiconductor space, give us faith management are able to effectively allocate their capital, and we can see not only above 10%, but increasing as we can see now sitting at 30. Investors will love to see that, and we already touched upon efficiencies earlier in the episode. We want to see margins increase over the longer term, and we can see not only above the 16%, but going from 30 in 2015 to 32, and as we saw, gross margin also increasing. Same to be said for free cash flow, well above the minimum 5%, but inconsistency year on year, now sitting at 32. And the final metric, maybe one of the most important and probably our favorite from ASML, the net debt to EBITDA. What you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. We want below 1.5 for the semiconductor space. Remember, this metric correlates to balance sheet strength, dividend safety, effectively telling us over the last 10 years and over the next 12 months, it won't even take ASML one day to pay off all of their debt net of cash on hand. Very strong balance sheet, and dividend looks to be secure. We'll also compare them against the sector where growth they do get a C+. Now, in terms of year-on-year revenue, up 3%. That was below the sector at 5.5%, also below their 5-year at 20%. Forward looking around 10 to 11%, above the sector at 7%, but below their own 5-year at 16%. So we can see they are expected to grow slower than they have done over the last 5 years. Yet in terms of earnings per share, expected growth 19% over the next 3 to 5, well above the sector at 13.9, but a little bit below their own 5-year at 23.4. And then if we move to the profitability, they do get a very strong A+, gross margin 51%, slightly above the sector at 50, slightly above their own 5-year at 50 as well. Bottom line, 27%, well above the sector at 4, pretty much in line with their own 5-year average, as well as generating a significant amount of cash from operations, just under 12 billion, when the sector comparative 110 million, but also a lot higher than their 5-year at 7.73 billion. So as we've just highlighted, yes, it trades at a premium, but in comparison to the sector, the majority of metrics do look overwhelmingly a lot stronger, and therefore it is deserved. Now, we've already covered their revenue, which has in fact increased quite significantly over the last 10 years, going from 7 billion in 2015 to now sitting at just under 30. But we want to understand, for a cyclical company, what does the bottom line net income tell us? Does it follow a consistent story? And the answer is, for the large part, yes, going from 1.8 billion in 2015 to now sitting at 7.8, which is a good sign, especially for a company in a cyclical industry. And then if we do a very quick health check, total cash versus total debt, nice to see cash has been increasing over the last 10 years. 3.7 billion 10 years ago, now sitting at 13.2. And as always, one number in the balance sheet will never give anything away, so we compare it numerically and directionally to their total debt, and we can in fact see their total debt, whilst it has increased over the last 10 years from 1 billion in 2015 to now sitting at 5, their cash balance is far superior, and as we saw, 0 on the net debt to EBITDA. It won't even take them one day to pay off all of their debt net of cash on hand. We'll also show you their performance against others in the semi space like Applied Materials, KLA Corporation, and some very well-known other companies, and we notice total return including dividends reinvested over the last year, ASML one of the worst performing, down 28%. But what this also highlights is when we look at their competitors, pretty much every single company in the industry has performed very terrible, so not a great year to in fact be invested in this industry. And if we expand to over the last 5 years, a slightly better story. It is at 153%, although one of the worst performing. As we can see, actually over the last 5 years, semiconductor space hasn't necessarily been a bad industry to be invested in, and over the last 10 years that does become a little bit clearer. ASML up around 600%, very strong. Actually, everyone would probably love that if their performance in their portfolio yielded something something similar, but actually it's been one of the worst performing in the industry. Quite a lot of them, a lot better returns, but remember, past performance is not an indicator of the future. And if we were to do the exact same comparison against the S&P, well, they've underperformed massively over the last year, negative 28%, S&P up 7%. Over the last 5 years, it does in fact switch, ASML massively outperforming, and the same conclusion does hold true over the last 10 years, ASML up 600%, the S&P a lot lower at 155. But give us your thoughts. Do you believe ASML can continue to outperform over the longer term? And just before we jump into our own valuation, we want to let you know we have released our latest free weekly article. We draw on every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to 35 severely undervalued stocks for the month of April, lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a recently released copy of stocks that Wall Street believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now jumping into our valuation for ASML, we have it at just over $1,000, derived from the DCF model, and when we take a look, we have the free cash flow year on year, including 2024. Average growth 41% over the last 10 years on average. We've gone 14 moving forwards. As you can see, low, medium and high, 12, 14 and 16% respectively. And as always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for ASML or any others. But based on 14% and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, just over $1,000, indicating 60% upside. But we'll also show you full transparency at 16%, 1,209, 83% upside, and at the 12% point, 920, 39%. As we typically do on this channel, we take through the median rate. So at 14%, we're not just done there, because we always like to apply a margin of safety. 10% execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today, a buy at $950, then we keep going till it's near the current trading price. And in today's episode, we're effectively saying not a 40% MOS just yet, but you're getting somewhere between 35 to 40%. Wall Street themselves, very bullish, buy signal. They see this at $943 over the next year, in turn translating to 43%. Give us your thoughts. What do you think about the earnings? Is it now time to consider 35% MOS at the bare minimum, 43% upside, ASML, buy, hold or sell? And we'll also show you, for those that believe we should use the lower rate, at 12%, you are still getting a fairly attractive margin of safety. As we do keep on going today, you're getting 30%, not just quite yet at $644, but at least 25% up to $690. So based on 12% growth to the future free cash flow, 25 to 30% MOS, Wall Street themselves still 43% upside. And we'll even show you, for those that believe we should look at the 10% rate, that you are still getting a margin of safety, so it does look incredibly attractive. 10% a buy at 721, at 20% not quite there yet. So for ASML, if you believe future free cash flow growth at 10%, 15 to 20% MOS, again Wall Street $943 price target. Do you see this, again as we said, as a buy, hold or sell? Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our weekly buys and sells, and as always, have a great day. We'll see you all on the next one.